The index is going to close at 1238. He's here now to talk about this. Adam, we survey all the big strategists, and certainly your call has been getting some real pushback. Tell me, why do you think that we're seeing the end of this profit recovery we've been in?
Well, actually, at Morgan Stanley, our forecast is really more differentiated on the multiple we're going to pay for the earnings, not the earnings themselves. So we're forecasting 10% earnings growth this year, which is certainly above the long-term average the S&P's achieved. So our contrarian call is really more on the market multiple offsetting that earnings growth.
And that pushback on the multiple is happening, why?
Well, our view is the multiple contracts because growth is decelerating already. We think 2012 earnings will be below 2011. And if you think about setting a target a year from now for the S&P, you're going to be thinking through at that time what 2012 looks like. And we think growth will be lower than it is in 2011. I think you also have the specter of inflation, which is bad for multiples, and a number of tail risks out there, whether they're European sovereign debt or the debt ceiling or Chinese inflation or something yet, sort of less picked over.
Yeah, one of those tail risks you highlight as well is deglobalization. What do you mean by that?
Well, look, there's a number of things that make the world different than it used to be, and the U.S. can no longer be thought of in isolation right now. You have to think about Europe, you have to think about China, you have to think about Latin America, and that's one of the strengths of Morgan Stanley is we have a number of talented people in each of those regions.
So just meaning we're going to see more sort of individual countries struggle with their own policies, and it's not going to be as simple as a gravity shift towards the east and that kind of macro bet?
I think so. I think you can't look at the U.S. in isolation anymore. If Chinese experience inflation, that impacts the U.S. If there's a sovereign debt crisis in Europe, that impacts the U.S. And our view is that that's likely to make the market multiple contract some or make people nervous about what multiple they were going to pay for this year's earnings if they're not sure next year's earnings are really going to be as robust.
Okay. Well, we're going to start seeing companies report their earnings this week. Are we going to start seeing these trends you're forecasting right now?
I think the catalyst to make people perhaps a little more sober is on the margin side, the profit margin side. The estimates peak in the middle of this year for profit margins. They peak in the July earnings. And you can show historically that the market sold off 3 to 6 months anticipatory of that peak. So there is some empirical evidence that you could get some news flow. I think the things I'm watching for in earnings are around inventory. Does that build on margins and margin guidance? Because we're worried about commodity costs and the huge rise they've had and what they do to profitability.
Right, and talk to me about that, because we seemingly are hearing from so many strategists right now, triple-digit oil in the year to come. Where is that going to hurt companies the most? Is it the consumer side?
Well, I think it could hurt the consumer discretionary companies where consumers just can't afford to spend the same amount on discretionary items as they do on hard, soft commodities and durables. But I think from the profit margin side, from the company perspective, you're already seeing some signs of that. At Morgan Stanley, we've been writing about food retailing and apparel and specialty discretionary companies who have all started to see some signs that rising commodity costs are hurting their profits.
So the counter argument to some of your forecasts here are just that we have the Federal Reserve establishing some support here with quantitative easing that's supposed to be, helping to buoy equities. You've got all of this retail cash on the side, corporate cash on the sidelines as well. Why will that not necessarily move the needle the way that so many are betting it will?
I think the corporate cash is clearly there. Our view and some of our themes we've written about is that that'll be good for M&A and that'll be good for dividend growth, and you want exposure to those kind of stocks in your portfolio. But I think I don't think you can show historically that inflows in the equity markets automatically happen at a higher multiple or drive the market higher, because asset classes are correlated. So, it's funny, over the long term, if you looked at the correlation between GDP and the stock market, it's about zero. So there's plenty of evidence, historically anyway, that the market could be anticipatory. It could already be showing some of the healing that people are currently thinking is still more in front of us.
Adam, it's been good having you on the show. Thanks for coming on and pushing back on some of the investors who've been questioning you. We'll see how your forecast fares there. 1238 for close in the S&P.
Good to chat with you, Marty.
Thanks. Stay with us. As we told you, Duke Energy is buying up another power company to create the biggest utility in the United States. The cost, almost $14 billion. That's just one of the deals in the news this morning. We'll take you to our deals desk.